All right, people, what's going on? Welcome back to the channel. Today, I'm starting a brand new series where I take a look at some key investments that's held by very prominent value investors out there, and we try and break them down and understand why we think they are invested in these companies and essentially what's so great about them. And who better to start off this series with than the big short himself, Mr. Michael Burry. So Michael Burry, obviously a very famous value investor, having shorted the housing market in 2008 and made a lot of money doing so. People do seem to be very, very interested in pretty much everything this guy says, even though he does have a bit of a tendency to flip-flop on his opinions and what seems like a very short period of time and make very, bold claims on Twitter and whatnot. But nonetheless, one of his largest holdings in his portfolio currently, as of the most recent filing of his 13F, is Expedia. So I got curious about this one and I decided to look into it, and I'm pretty glad that I did because this company is a rather complex company with a lot going on. There's a lot of different businesses that it owns, but it is a very interesting one. And it's a prime example of how sometimes if you just, you look at a company from a different lens and you kind of adjust how you view a certain company in a way that's different than perhaps other investors are, you can find value hiding in plain sight. So this is what I want to cover in this video. It's probably going to end up being a rather long video because we do have a lot to get into. So make sure you're sitting somewhere comfortable. And yeah, without further ado, let's just dive right in. So Expedia is a online travel agency, or OTA. I'm just going to call them an OTA throughout the rest of this video because using acronyms makes me feel smart. And they have three total segments. And I want to talk about all of these segments in a little bit of depth because understanding these three segments and how they work and why they're different it's pretty important to understand the whole thesis behind Expedia and why we think that Michael Burry has put almost 10% of his portfolio into this one company. So there's three segments. Firstly, there's the retail one, which as we can see is by far the largest segment. And this is the consumer travel focus segment. And it includes things like number one, Expedia.com, which is their core OTA. That's kind of the big brand that they operate. And then there's smaller ones like hotels.com, Travelocity, and then many other smaller brands out there that are kind of similar OTAs. But it also includes VRBO or VRBO, which is Vacation Rental by Owner, which is a direct competitor to Airbnb. And this is more vacation home focused. It's found specifically operating in the US, but the idea of it is pretty much the same as Airbnb, where property owners can rent out these vacation homes that they own for short periods of time to other people. And I'm going to do a whole segment in this video later on talking about VRBO specifically and going in depth on them because personally, I think VRBO is a big reason why Michael Burry sees hidden value in Expedia. But then there's also, as we can see here, the B2B segment, which is the second largest segment. And they also call this segment Expedia Partner Solutions. That's another name for it. And in a way, this segment is actually kind of similar to AWS, Amazon with Amazon Web Services, because if you recall, the way that AWS was born was Amazon realized through developing this massive e-commerce infrastructure that they had and all the tools and techniques and best practices that they had created to manage an e-commerce store and the varying levels of traffic that you have to deal with for an e-commerce store, they realized all those things and all that computing power that they had could actually be pretty valuable to offer to other companies. And you could kind of package that up and all those different services and sell computing power kind of as a pay-as-you-go service. So other companies can get better at, managing their computing power if they have websites that vary in the level of traffic, which a lot of websites do, right? Especially e-commerce companies. So that's kind of how AWS was born, right? It was kind of born by accident where just through the natural course of Amazon, trying to optimize their e-commerce business, they by accident created this whole other beast that ended up being this hugely profitable segment that we now know as AWS and just cloud computing in general. So in a way, on a smaller scale, but the B2B segment for Expedia is very similar to that because this B2B segment is Expedia selling access to their technology to other online travel agencies out there or just travel companies in general. So they can brand Expedia's whole infrastructure as their own company and not have to pay for all the massive costs associated with setting up an online travel agency. And when I say, all the technology and the infrastructure, I just mean things like Expedia's booking engine that they have, the inventory of listings that they have on their site, pretty much everything you need to operate an online travel agency. And then other companies can pay them for that. again on like a pay-as-you-go service, and they can just slap their own company branding onto Expedia, and they'll have their own online travel agency. So it's actually a hugely profitable segment for Expedia overall, and it's really, very interesting because not a lot of companies are in a position where they can do this kind of thing. And now it may seem a little confusing why Expedia would be doing this, because you might think, well, aren't they just helping their competitors by offering this service to them? Wouldn't it be better to not do this? And in a way, yeah, they are helping their competitors, but from their point of view, there's going to be competition in this market no matter what, right? Whether it's you facilitating that or it's some other company facilitating that, if there's going to be competition regardless, then you might as well get a little piece of that competition. If your competition does well, then you do a little bit well along with them, right? So you're kind of insulated from that. And the way the segment makes money is basically if any of these third-party, online travel agencies make bookings using Expedia's booking engine, they take a little bit of a commission on that transaction. And on another note, it's kind of similar to SoFi. This is a bit of a tangent, but SoFi is a company I talked about a few videos ago on this channel, and they have this whole technology platform segment that they call, which is basically kind of doing the same thing, but for fintech companies. Like if you have a fintech company that wants to start a credit card issuing business or, a loan issuing business, whatever the case may be. Um, SoFi has this technology segment that offers the infrastructure so companies can go and do that. And in a way, they are helping their competitors, but there's going to be competition in the market regardless. You may as well get a little piece of that. And then the last segment here will be Trivago. So this is a company that they own a majority interest in. It's their smallest segment as well. And this is basically a Metasearch company, which is a website that people use to search for hotels, tours, cruises, flights, etc., pretty much everything related to travel. And they earn revenue, again, similar, they earn revenue through referrals and commissions. So when someone makes a booking that was discovered through the Trivago Metasearch, searching algorithm, then they would earn a little piece of that transaction. And some other examples of Metasearch companies out there is Kayak is one, TripAdvisor is one, and then Google itself has actually introduced their own Metasearch. I think they call it Google Hotels, there's Google Flights as well. Those are all Metasearch companies. And most people start their, search for travel options using Google, and Google has been, pushing these own services that they've created more and more. So that's actually a massive competitive threat for Expedia's Trivago segment here is the rise of Google and their, whole offering on that. Now, before I go any further, I want to give a quick backdrop of the online travel agency industry as a whole and talk a little bit about some key trends that we're seeing in this space. Because, again, this is pretty important context to understand why Michael Burry has probably established a position in Expedia specifically, at least for now. So, I've got this on screen here, which is something that I pulled from an article in Value Investors Club, and it kind of explains the whole stack of booking travel online. So, you have, your search engines, which is where it all starts like Google, Bing, Yahoo. And then you have the meta-search companies, which we just talked about. So this could be Trivago, Kayak, TripAdvisor, and then Google Hotels and Google Flights is on here as well. And then you have the online travel agencies themselves, which is all the ones here. And what you're going to notice about this is online travel agencies are essentially an oligopoly. You have obviously Expedia is one. Expedia owns all of these companies here. They have a majority ownership in Trivago as well. And then there is BKNG or Booking Holdings. So Booking Holdings, they're this massive, like $100 billion company, whereas Trivago is around 15 or 14 billion dollars, and they're a large player in this space as well. They're the biggest competitor that Expedia has, and they own many different brands like Booking.com. They own Priceline. Kayak is their meta-search business. They also own OpenTable for restaurant bookings. And when you look at Expedia, if we go back to this chart here, there's many brands that they own, but the brands are just in total, they're a smaller size when compared to BKNG. But if you think about it, right, this is pretty much the whole, travel booking stack that's out there that's owned by these two companies. Now, of course, you have another very formidable competitor that we have to also mention, which is a company that has been, making a lot of waves, especially recently, and that's Airbnb. Now, Airbnb is kind of, they're the disruptor of the industry, right? And they're a company that recently they reached profitability. If we look at their If we look at their, we'll look at their cash flow statement here on a quarterly basis. We can see for a few quarters now they've been doing close to $1 billion in free cash flow per quarter, and they're a large company now as well, market cap of $77 billion. So they're a formidable competitor. But with Airbnb, right, I think at this point in Airbnb's history, we've seen enough of them to know where they stand, right? In other words, like we know how disruptive this company is actually going to be now. They're not gonna make hotels obsolete, right? But what it is an entirely new option for travelers out there, which in some cases can be more cost effective than a hotel, and it can also be very beneficial for hotel owners or owners of, their own private property. And what it's been labeled as is alternative accommodation, right? So it's another option that travelers have. It's not something that's going to completely disrupt the industry and, make all these online travel agencies go out of business. It's just another option out there. And these online travel agencies are competing with Airbnb in different ways now. And we also know that Airbnb is really focused towards, individual travelers. They don't really cater to corporate travelers that much, who usually are only booking, one night stays at hotels or when they travel abroad. Airbnb is much more consumer focused. So that's another key difference there. Okay, so that covers kind of the competitive landscape of online travel agencies as a whole. Again, the key thing to note there is that the industry is essentially a massive oligopoly with pretty much all the companies being controlled by one of two companies, which is Expedia and Booking. And then you also have Airbnb, which is this new entrant that isn't disrupting them per se, but kind of is a new option that travelers have now that compete with them in very specific ways in specific lines of businesses. So the next thing I want to talk about is the business models that online travel agencies will follow. And again, this is very important context to have because it'll help you understand why Michael Burry is interested in Expedia and why it's actually an interesting investment. So when it comes to traveling, the vast majority of travel expenditure is going to be on one of two things. It's going to be on hotels and flights. Those are the two, biggest costs of traveling. So within that, you have two key business models. They've listed three here, but I want to talk about the first two, which is the merchant model and the agency model. So with the merchant model, what it's typically done is the OTA will buy in bulk a bunch of hotel listings from a hotel, usually at a lower discounted rate, and then they'll resell them on their agency platform. Now, the problem with that is it carries inventory risk because if you aren't able to sell all of those hotel rooms for a price that's higher than what you bought them for, then you could incur a loss in doing that. So, because Expedia is again such a dominant player in this industry, part of that oligopoly, they don't do that. They're able to negotiate a better deal for them, which under this merchant model is usually what most of the it's usually what most of the hotel spending is going to look like. So what they do instead is similar to the merchant model. Expedia will negotiate a discounted rate with the hotels, and then a customer will come onto their platform. They'll have those hotel listings there, and the customer will pay Expedia the full rate. And then Expedia takes the booking details from the customer, they pass it on to the hotel, and then they pay the hotel that lower negotiated rate, and then they profit the difference essentially. So it's better for Expedia because they have no inventory risk. So it's not quite, the merchant model in its purest form, but in a way it's similar because they're kind of doing the same thing. It's just they skip the whole inventory risk part. So it's more favorable for Expedia in that sense, and it kind of speaks to their, market power and their influence in this industry. And then the other model is the agency model here, which is basically just the OTA receives commissions for any bookings that are made on their platform. So this one's a lot simpler. And this one could usually be things like flights, and then hotel bookings could also fall under here. Remember, you also have rental car purchases, cruise lines, pretty much anything related to travel. And then the advertising model, which is a bit different. I'm not going to talk about this one too much because it makes up for a smaller percentage of their revenue, just 8%. Um, Now, what's also important to note, and this kind of, again, it speaks to the whole industry dynamics and how, you know, certain companies have more power over other companies as part of this whole stack of, booking travel. The commissions that Expedia earns through booking flights is much lower than what they earn booking hotels. And the reason for that is because the hotel industry is much more fragmented, right? So when it comes to air travel, you really only have so many airlines out there, right? I mean, usually each country will have two, three, just a couple major airlines that can, carry passengers internationally around the world. Some of them are going to be state-controlled corporations as well. There's a lot more hotel chains that exist in the world than there are airlines, right? I think that's kind of common knowledge, right? So because of that, airlines have much more negotiating power over online travel agencies when it comes to negotiating how much they earn on facilitating bookings through their agencies, right? Whereas with hotels, there's a lot more hotels that exist around the world, and a lot of them are pretty small, so they don't really have that same negotiating power. Of course, you have larger players in the industry, like there's Hilton, there's Marriott, a few other ones, but overall, hotels are much more fragmented. And again, because the online travel agencies are dominated by really just two key players, then when it comes to negotiating these rates, whether it's the merchant model or the agency model, the OTAs are going to have significant influence over hotels, and they earn a lot more revenue by facilitating hotel bookings than they do other things. So that's important to note, right? Okay, so now that we have all of that context about the industry and the business models and the company itself, let's actually answer the key question of this video, which is why does Michael Burry own this company specifically? So simply put, Expedia, they operate in a market that is objectively an oligopoly that is growing every year. It's not a industry that's growing massively, but OTAs in general are expected to grow over the next 5 years, kind of in the high single digits. And the incumbents in this space, so Booking and Expedia, are only expected to get bigger and more influential overall. So those traits that I just described, that actually seems to be a pretty common theme that a lot of these so-called super investors will follow when they're making their investments. And another prime example of this is a video that I did a while back on Micron stock. So basically what I'd noticed was that a disproportionately large amount of these so-called super investors owned large stakes in Micron stock. And part of their thesis for that was Micron provides a essential technology for the modern world, these DRAM chips, and there's only a handful of suppliers out there, and Micron is really the only American-based supplier. There are other suppliers in Korea, but they were the only one in America, and there was only, I think, three major suppliers of these chips overall, and these chips do get used in pretty much all of the modern technology that we enjoy today. And the barriers to entry of this market, so let's say another company decided they want to start a competitor to Micron, they're extremely high because you'd have to build out this massive manufacturing plant that would take multiple tens of billions of dollars to do and probably 10 plus years before you can even begin to make money and recoup some of your investment. And even then, that's only when you get a shot at competing against a company like Micron, which already has multiple decades head start on you. So it's pretty much an impossible thesis, and because of that, Micron has this massive moat around it. But the problem with the business is it's highly cyclical, and if you invest in it at the wrong time, you can actually end up losing quite a bit. So it is a very risky company, but if you are willing to stomach that risk and you can understand the market, then you can do pretty well with Micron stock. Now, OTAs aren't exactly like that, but they do have some similar characteristics where, it's a growing industry. It's one that is only going to become more and more important for users going forward. And there's only a few companies, and it's very hard to disrupt them, right? Because when you think of a business model like this, you think of network effects, right? Where OTAs that have more booking options will attract more customers, which in turn attracts more suppliers that want to list their booking options on their platform to get access to those customers, which attracts more customers. And, it's this virtuous cycle that develops. And even, a very formidable competitor in Airbnb, as successful as they've become, which they have become objectively a more successful and better business than Expedia at this point in time. But it took them many years and many billions of dollars of investment and pretty much, the whole world believing that they were this massive growth story that was going to disrupt the industry. It took all of that for them to even have a shot at competing in this industry against these companies. And they have done that successfully. But again, they're competing in a very niche space, a specific space, and they're not really disrupting the online travel agencies in their core business. Now, something else that was mentioned a lot in regards to these companies, something that I actually don't really think I agree with, is the operating leverage. And so, operating leverage, it really just refers to the extent a company can grow their revenue at a pace that exceeds their expenses. So, what we're going to do is we're going to look at their revenue here, and then I'm going to add another chart looking at their EBITDA. And by the way, if you're wondering what this website is that I'm using here, it's called tickernomics.com. This is a website that I created myself, really just to help retail investors, get better access to information and analytical tools to look at stocks. So if you are interested in using this site, it's currently free to use. Link is in the description, so feel free to check that out if you want. So this chart here looks at revenue at the top here and EBITDA. So revenue growth is outpacing EBITDA. Now, if this business model truly had operating leverage, you'd expect to see EBITDA growth outpacing revenue, but that's not really what happened. So now this is what it looks like with Expedia, and obviously we can see this whole trend kind of buckled a little bit in 2020 and 2021 because of that thing that happened in those years that really caused a decrease in spending on travel. But in the more recent years, we're starting to see this operating leverage unfold a little bit, where EBITDA seems to be increasing at a larger rate than revenue. But again, this rate remains to be seen, right? It's very difficult to tell just from this one chart alone. So let's look at booking holdings, right? So I'll type them in here. They're a much larger company, right? Over $100 billion in market cap. So very formidable competitor. And let's look at what this same chart shows for them just to see, try and understand this business model a little bit better. So type them in here. And we'll look at the same metric, EBITDA over the trailing 12 months versus revenue over the trailing 12 months. It looks relatively the same. It does seem like there was a bit more operating leverage in this space here where EBITDA was growing at a decent rate, but very similar pattern overall. So this business, it is a very good business. It's extremely free cash flow generative, but it doesn't really seem like it has the operating leverage that people, would like to believe that it has, in my opinion. Now, something else I want to look at is the price to sales ratio. And we're going to look at it for BKNG, and then I'm also going to pull up Expedia so we can compare the two. Again, these being the two major incumbents in this industry. So obviously there's this spike in the price to sales ratio around this time because these companies had sales go down quite a lot. But there is kind of this overall pattern where it was quite high around here. We can see about 9 price to sales for Booking and then 2 for Expedia. And then we go here, it's now much lower, 5 price to sales for Booking and 1.1 for Expedia. And by the way, if you're wondering what the discrepancy is, why there's such a larger price to sales ratio for Booking than there is for Expedia, well, I'll pull up this table here, which I created using custom tables. So this just looks at various players in this industry, and we can add some key metrics related to them. So I created a table that has the market cap, their operating margins, price to earnings, and then enterprise value to EBITDA. So just some key valuation metrics. So we have Booking Holdings here. Their operating margins are much, much higher than Expedia's, 32% over the last 12 months versus 10 for Expedia. So that's why that's the reason why. That's the reason why their price to sales ratio is so much higher because their sales are just more valuable because more of those sales get converted into actual bottom line profit. And it also, just that general decrease that we see, it has to do with investors basically readjusting their, optimism regarding online travel agencies as a whole because of a lot of competitive threats that have emerged over the last pretty much 10 years. So one of them is Airbnb, right? But I think that's a small one overall, right? Because again, they don't really compete with OTAs in like their core business as we've now learned. But I do think that is part of it. But what we're also seeing is hotels kind of trying to bypass online travel agencies. And they've done this by introducing their own loyalty programs. And they really want people to book hotel stays not through online travel agencies, but instead going directly to their website and doing that. So there's this real push for the dominant, hotels chains out there to start doing that. So they have their own loyalty programs now. Sometimes they just offer better prices when people book on their websites versus through either Expedia or Booking.com, whatever. And then you also have that emerging threat of Google in the Metasearch space, which is it's a big problem for these companies, right? Because everyone starts their search for travel on Google, right? They're the dominant search engine. And if Google just introduces their own solutions and puts those at the top of the search results, there's not a lot these companies can do about that. So there's a lot of threats to this industry, right? It's not all, It's not a perfect industry, and we've seen, investors kind of become less optimistic by, reducing the valuation multiples for these companies. So this, overall, it explains why Michael Burry would want exposure to online travel agencies as a whole, but why specifically Expedia? Why not, BKNG? They are a larger company, they have better operating margins. Why wouldn't you want them? Why has he opened a position in Expedia? Or why not even Airbnb, right? I mean, that's a company that's been doing some interesting things as well and is currently making a lot of free cash flow. Well, one possible reason, and I hinted at this earlier, and it's their ownership stake in VRBO, which I'm going to dive into now. Okay, so now let's dive into that VRBO segment. And this is kind of what offers the company that hidden value. And this is going to become apparent when I just do kind of this quick analysis where we compare valuing VRBO as if it was Airbnb, and we see how much of a market cap VRBO as a company would have if it was its own separate company. So to start, let's look at what the market cap of Airbnb is. And I also included the enterprise value here just to show that it's pretty similar to what the market cap is. So the market cap is about $73 billion currently for Airbnb. Now, if we value Airbnb on a price to revenue basis and then also a price to gross bookings basis, which over the last 12 months, as of Q2 2023, they had about 9.3 billion in revenue and then about 68.6 billion in gross booking value. So what is that as a multiple? Well, as a multiple of revenue, it's about 7.7. As a multiple of bookings, it's just over 1. Now, unfortunately, I couldn't find any up-to-date stats on VRBO as its own operating segment. I was able to find what their 2019 revenue was and what their 2019 bookings were. Just found that online. So I kind of just did some estimates to project how much this company has grown going into the future, basically over the next 4 years into 2023 to get an estimate of what their revenue and their bookings look like now. So let's say revenue conservatively was growing at 5% a year and then also growing at 10% a year. Under 5% a year, their revenue in 2023 would be about 1.5 billion just for the VRBO segment. And then at 10% a year, it'd be about 1.8 billion. And then their bookings would be about 14 billion with 5% growth, and then under 10% growth, just under $16 billion in total gross booking value. So what if we take these Airbnb multiples and we apply them to the revenue and bookings in 2023 of what we've estimated VRBO to be? And by the way I created these estimates was I basically just looked at number one, what was Expedia's revenue overall going from 2019 into 2022, which it was pretty much stagnant. It was actually down slightly from 2019, 12 billion to just slightly under 12 billion in 2022 here. And then I looked at the same period for Airbnb. Airbnb had very, very strong growth. So it was kind of hard to determine exactly how much the VRBO segment has grown in that time period. But I conservatively estimated it to be somewhere in the middle, right? So about 5% growth and then 10% growth in revenue and bookings as well. So here's the VRBO valuation as its own standalone company under those multiples. So it would have a market cap with the 5% growth, which remember is the conservative one. If valuing it relative to revenue, it'd be about 12 billion. Relative to bookings, it'd be about 14.6 billion. At 10% growth, you're looking at just under $14 billion in terms of the revenue, and then if we're valuing them relative to bookings, 16, almost $17 billion, which is larger than all of Expedia currently. Expedia is a company as a whole, which remember you also have, Expedia, you have all the other businesses that they own, you have that B2B business as well, which is all profitable, all making, additional cash flow. This is just looking at VRBO, and arguably based on those multiples, VRBO is, more valuable than the rest of Expedia as a whole, which Expedia, the rest of it is still a large company that makes plenty of money. Now, the problem with doing this analysis is, because we can see the market cap here, this is the market cap of Expedia, just over $14 billion. The problem is the percentage that VRBO earns per transaction that occurs on their platform is actually slightly less than it is for Airbnb. What's called their take rate, it's about, I believe, 30% less than it is for Airbnb. So they're not making quite as much money per transaction as Airbnb. So because of that, it's not fair to value them under the same multiples as you would with Airbnb. So we can't really say that these companies are worth this much. But remember, if they are worth this much, then we're basically saying that VRBO alone is more valuable than the rest of Expedia. So even if we apply a 50% discount, we still get somewhere in the range of $6 billion to $8.5 billion, again, just for this VRBO segment. So this, I think, is a key reason why Michael Burry owns this company, because there is this segment that doesn't have a lot of disclosures around it. I was looking at their most recent filings, and it was pretty difficult to find some up-to-date data on VRBO. They do obviously mention VRBO, and they talk about different things in their earnings call transcripts, which is where I discovered this thing where they earn less per transaction than Airbnb does, because that was something they mentioned specifically in one of their earnings calls. But they don't, provide detailed financial information, at least from what I've seen. Maybe they have in the past, but that, kind of that opaqueness offers some hidden value to this company. And I think it's fair to say that VRBO as a business is worth a few $1 billion, which, I mean, that means that you're getting a large chunk of the rest of Expedia when you invest in this company, at a much discounted price if you strip out VRBO and then look at the rest of Expedia's businesses. So that's what makes it very interesting. And that is what I think is a big part of why Michael Burry owns this company. Okay, so the last thing that I want to cover in this video is I want to do a quick valuation of Expedia stock using the discounted cash flow method. And to do this, I'm going to use the value a stock feature on my website, Tickernomics, which this follows the discounted cash flow method. And we basically just enter the ticker that we want to value in here, and it's going to load the data, and it's going to first, it's going to calculate an intrinsic value just based on some preliminary assumptions, which we're going to have to adjust these a little bit to make them more indicative of what the future for Expedia will look like. But the reason why I always want to do this in these videos that I do is to show you guys how important it is to understand what assumptions are currently baked in to a company's stock price, because that's very foundational knowledge to know whether or not you think a company is going to outperform or underperform. Because if you think the company is going to do better in the future than the results that, their share price would indicate, then they might outperform, right? But if you don't think that those assumptions are reasonable, then it doesn't really make sense to invest in this company. So I'm going to keep things rather conservative to start. We'll say 5% revenue growth each year for the next 5 years. Our operating margins will stay constant at, we'll say 7%. Our tax rate will change that to 21%, which is usually around what it is for large multinational companies with some foreign operations, which Expedia does have. Capital expenditures, depreciation, amortization, we'll leave that the same. We do have to make this adjustment to working capital, and we're going to make it, instead of positive 3 billion, we're going to make it negative 1 billion. So working capital is actually kind of a cash inflow of $1 billion. And the reason I'm doing this is because if I go here, which this is their statement of cash flows as of their most recent 10K filing for the 2022 year, we go to this section here, which is basically our working capital section. We have the changes in accounts receivable, prepaid expenses, accounts payable. They have this one unique account called deferred merchant bookings. And in the past 2 years, this was a large cash inflow for them, $2.6 billion here and then $1.4 billion here. So these are going to fluctuate year to year, just depending on timing and whatnot. But each year, if we kind of, sum all of these together, we get about a $1 billion cash inflow, roughly speaking. It's not exactly that, but roughly speaking, that seems reasonable. So I'm going to change that to just 1 billion. The share change, I'm going to make that 0. The terminal year cash and terminal year debt will leave the same. And then our terminal value multiple will change this to 8, which this uses enterprise value to EBITDA as the terminal multiple, which, to just show you quickly what this looks like, I'll open up this multiple so I can show you what it's been historically. So we go MMEV to EBITDA, and this is going to show this metric. We'll zoom in to get a more recent view of it. So it's been about 8. We can see it's currently about 7.5. So an 8 multiple seems reasonable. And I'll change the discount rate to 8%, right? It says they have a cost of capital of 7%, but 8% is a bit more reasonable. So I'll recalculate the DCF using that, and we pretty much get right on with the current share price. We get an intrinsic value of 96 per share. Current share price is 93. So this is pretty much what investors are expecting Expedia to do. 5% revenue growth, 7% operating margin. So if you think they're going to do better than this, then, Expedia looks interesting. Like let's say they're going to have 15% revenue growth. This is quite a bit higher, right? Significantly higher. Actually, we're saying 3 times. Now their intrinsic value starts to look more interesting, but it didn't really increase that much, right? It went from 93 or 96 to 125. That's, roughly a third increase there. What happens if instead they can get their operating margins to, from 7% to 9% over the next 5 years? What kind of an influence does that have? A significantly greater influence, right? Now you're talking, this is really the undervalued territory where your intrinsic value is, significantly higher than what the current price is. So this is where Expedia would start to look interesting. And again, you can adjust other assumptions as you see fit. But yeah, that pretty much does it for this video, guys. I hope you did enjoy this and you got value in this. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.